Vast LN 13 December 2019. Exposure to copper and rough diamonds in Romania and Zimbabwe. Vast Resources is an AIM-listed mining company with a portfolio of exploration, development, and production multi-commodity assets in Romania and Zimbabwe. Flagship development projects include the fully permitted high-grade polymetallic brownfield Baita Plai deposit, Romania, with good access to historic infrastructure and first saleable concentrate expected in H1/20, and the alluvial diamonds. Chiadzwa Concession in the prolific Marange Diamond Fields to be developed in a JV with a local community and fast-tracked to production. Baita Plai, 80%, a fully permitted, funded, and close to production brownfield polymetallic mine. Is a low capital intensity and high margin project offering exposure to copper along with a series of precious and base metals byproducts. The mine is expected to launch operations in H1/20, delivering 4 KTPA CUEQ and yielding $17 million in EBITDA, 60% margin, and $12 million in FCF annually, at $7,500/TCU price, once ramped up to full 13 KTPM capacity. Chiadzwa Community Diamond Concession, TBC%, an unmined license area in a prolific Marange Diamond Fields that supplied 60 MCTS over the last 2 decades, is the second major project in the group. A potential alluvial diamonds operation can be brought quickly into production and at a low capital cost. On preliminary management estimates adjusted for lower than planned plant availability, 50% v 85% budgeted by Vast, the project is expected to run at 1.2 MCTS in annual production, generating $45 million in EBITDA and $33 million in FCF per annum, at $58/CT rough diamond price. Karli Baba Extension Project, 100%, is part of the Manila polymetallic mine, on CNM since DIS/18, and an opportunity to restart operations at reduced unit costs allowing positive FCF potential. Exploration potential remains in the highly prospective Eastern Carpathians and Apuseni Mountains, allowing to further improve on the life of mine of planned operations in Romania. While the scale of the Chiadzwa Community Diamond Concession is yet to be determined at the time when Zimbabwe aims to attract investment in diamond industry and nearly double local output to 6 MCTS by 2023. Conglomerate source only and not accounting for incremental supply from alluvial operations. Vast Resources offers exposure to a diversified portfolio of assets both in terms of commodities and jurisdiction, prioritizing pre-production projects with a view to deliver early cash flows while also working on a pipeline of early exploration assets. Using our DCF valuation model, 10% DR, we arrive at attributed NAVs of 0.37p adjusted for the development stage of each project. Upside to the valuation lies within further de-risking of the vast portfolio of assets, narrowing down the P/NAV discount that may potentially yield a 180% increase in attributed project value. $68 million v $191 million, translating into a 1.22p NAVs. In particular, Chiadzwa offers the most value upside in terms of gradual de-risking of the project, see valuation section. NAV valuation and investment case. We are using a discounted cash flow based NAV as our primary valuation tool for the portfolio of vast assets, including 2 flagship development projects, a polymetallic Baita Plai mine in northwestern Romania and an alluvial Chiadzwa Community Diamond Concession project in Zimbabwe, as well as the Karli Baba extension at the Manila copper zinc operation, currently on care and maintenance, in northern Romania. We arrive at an attributable NAV of $53 million or 0.37p per share, 10,253 MIS shares in issue, using 10% discount rate, our commodity price forecasts and respective adjustment multiples. We have applied adjustment factors to our NPV estimates to reflect the relative status of each project, implying a potential upside as the team gradually de-risks its portfolio of assets. Baita Plai, 80% interest, and Chiadzwa Community Diamond Concession, 60% interest. account for 67% and 25% of total adjusted NPV. Fast track from development to production. Vast Resources offers an exposure to a pre-production portfolio of assets with the polymetallic Baita Plai project planning to launch operations in H1/20, delivering 4 KTPA CUEQ and yielding $17 million in EBITDA and $12 million in FCF annually, at $7,500/TCU price, once production rises to full 13 KTPM capacity. Development diamond licenses in the Chiadzwa Community Concession area may also fast-track once economics of the project are confirmed, given the alluvial nature of the deposit, allowing for a low in capex and short in construction period. Delivery of the project. On preliminary management estimates adjusted for lower than planned plant availability, 50% v 85% budgeted by VAST, the project is expected to run at 1.2 MCTS in annual production, generating $45 million in EBITDA and $33 million in FCF per annum, at $58/CT rough diamond price. This compares to unadjusted VAST expectations for 85% plant availability, yielding 2.0 MCTS in production per annum and generating $77 million in EBITDA and $57 million in FCF per annum, assuming same rough diamond prices. Baita Plai 67%. Marange 6%. Chiadzwa 25%. Other 2%. Vast Resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. De-risking projects is a way to unlock value in the vast portfolio of projects. Development stage of vast portfolio assets varies considerably, offering a valuation re-rating opportunity as more work is completed to de-risk respective projects. For instance, we applied 0.75x multiple for the Baita Plai project, reflecting its pre-production status, 0.25x multiple for the Karli Baba extension at Manila given the pre-reserve and economic study level of the project, and 0.15x multiple to Chiadzwa Community Diamond Concession due to its pre-resource stage. In this regard, the Chiadzwa Alluvial Diamonds project offers the most value upside in terms of gradual de-risking of the project. See chart below. In aggregate, de-risking of the portfolio of assets may potentially see a 181% increase in attributable project NPVs, $68 million v $191 million, translating into a 1.22p NAVs. Attributable NPVs of portfolio assets without P/NAV discounts applied to projects based on a respective development stage. See multiples applied in the table above. De-risking the portfolio of assets may potentially see a 181% increase in attributable project NPVs. Source: Company, SP Angel. Permitted and funded to production. Vast Resources has recently signed an agreement with Atlas Capital Markets for a $15 million gross convertible bond facility to restart production at the $3.6 million Baita Plai polymetallic brownfield operation in Romania, as well as to advance the Chiadzwa Community Diamond Concession project in Zimbabwe. Exploration potential offers an opportunity to grow the existing mine life at Baita. The mineralization remains open at depths, while the present in-house mine plan accounts for only 2 of 7 identified mineralist pipes. The future of the Manila operation lies within the Karli Baba extension project, with the latest mineral resource update referring to an exploration potential to increase the current mineral inventory by 35 KTCU or 80% in open pit domain, defined as within 125 m from surface, and add up to 307 KTCU in the underground domain, assuming top end of the range tonnage and grade. The scale of the Chiadzwa Diamond project is yet to be determined, with a potential economically viable diamondiferous alluvials as well as conglomerate ore resources, given the prospectivity of the region that supplied 60 MCTS over the last 2 decades. Diversification among commodities and regions. Vast resources offers exposure to predominantly copper with other base and precious metals byproducts across the portfolio of assets in Romania and rough diamonds in Zimbabwe, with the spectrum of projects ranging from early exploration to pre-production stages, limiting risks typical to a single asset, single jurisdiction mining company. The team brings years of regional operation experience with established relationships with local authorities. Andrew Prelia, CEO, has been instrumental in establishing Vast's presence in Romania, leveraging off a strong network of contacts in the metals and mining sector. Mab Hudhu, director of the Zimbabwean Vast subsidiary, has previously acted as CEO of the state-controlled ZCDC, a party to the mining agreement at the Chiadzwa Community Diamond Concession, as well as having spent 11 years with Debswana, a JV between the government of Botswana and De Beers, delivering production and cash flows to reduce the cost of funding. The team negotiated a non-conversion period with Atlas that may see the company attracting cheaper sources of funding and avoiding dilution to shareholders once Baita Plai is up and running, generating earnings and cash flows. Future news flow. 1. Progress update at Baita Plai following drilling results and with first production expected in H1/20. 2. JORC compliant mineral resources reserve statement at Baita Plai, EXP Q2/Q3/20. 3. Mining license and final ownership structure agreement with regards to the Chiadzwa Community Diamond Concession project. 4. Maiden JORC compliant mineral resource estimate and an economic assessment of the Chiadzwa alluvial diamonds project, EXP9M, after securing the license. 5. Regional exploration and updates on development plans for Karli Baba extension at Manila are subject to capital availability with primary focus on Baita and Chiadzwa. NAVPS sensitivities, base case price assumptions and discount rates used in the NAV calculation are provided below. We singled out copper as the next most significant commodity exposure after rough diamonds. Chiadzwa Community Diamond Concession, accounting for 60% of Baita Plai payable metal production, see the pie chart below. Baita Plai payable metal production breakdown, $m per annum. Source, company. Hence, we have prepared sensitivity tables with Vast Resources NAV per share at various discount rates as well as copper and rough diamond price assumptions. Risks. We touch on a number of risks below which are by no means exhaustive that typically involve exploration and mining related risks, including geological, operational, political, environmental, financial and market issues. No JORC compliant mineral resources reserves on development assets. The only JORC compliant mineral resource statement is currently available as at Manila polymetallic mine in Romania that is on care and maintenance. No independently verified mineral inventory or economic studies are available on the other two flagship development projects, namely, Baita Plai and Chiadzwa Community Diamond Concession projects. Operational risk: mining dilution, equipment availability and maintenance, underground development, access to skilled labor. Metallurgical recoveries at the flotation plant and the quality of produced concentrates at Baita Plai are some of variables central to project economics. To this end, the company engaged third-party consultants to work on economic studies and is planning to prepare JORC-compliant mineral inventory estimates for its assets, while SGS is working on metallurgical tests for Baita to identify optimal flow sheet. Permitting: securing license for Baita Plai proved to be a lengthy process, 3 years, complicated by the involvement of the state mining company Baita SA. Permitting is reported to normally take 6-9 months. Regulatory risk: Zimbabwe is facing its worst economic crisis in a decade amid both structural challenges as well as weather-related disruptions from Cyclone Idai in March and regional drought. Power shortages, running away inflation, continuous fiscal and current account deficits, corruption, and inconsistent policy decisions are among few factors that have constrained business investment, private spending and ultimately economic growth. Amid challenging socio-economic background, Risks are for the government to potentially consider increasing fiscal burden on FX-earning industries including mining or reintroducing indigenization policy as well as an outright nationalization of the project. Zimbabwe geopolitical risk. Zimbabwe has been subject to the US and EU sanctions for a number of years on accusation of human rights violations, with the latest development involving the US issuing a ban on trading in rough diamonds from Zimbabwe, arguing the nation uses forced labor at its diamond fields in Marange. Sanctions undermines the competitiveness of diamond production from Zimbabwe in international markets, potentially adversely affecting realized prices for stones. The company is planning to market rough diamonds directly, avoiding Sanctioned Minerals Marketing Corporation of Zimbabwe, MMCZ, while the ZCDC is planned to be moved in the ownership of the Ministry of Mines from sanctioned Zimbabwe. Mining Development Corporation. Dilution risk. The company currently has no FCF generating assets and relies on equity and debt funding to develop the Baita Plai brownfield polymetallic mine and greenfield Chiadzwa Concession alluvial diamond project. Budget Projections Guide for Low Capital Investment Requirements for restarting the brownfield Baita Plai polymetallic mine as well as commissioning of the greenfield Karli Baba extension project, highlighting low-cost operations. Jurisdiction. Capital operating cost overruns and project delivery delays will put pressure on the company to source additional equity debt funding, leading to a weakening in the financial position or potential dilution. Commodity price risk. The Baita Plai polymetallic mine is expected to be producing copper, zinc, and lead flotation concentrates with gold and silver byproducts, while the Chiadzwa Community Diamond Concession is forecast to produce industrial and gem-quality diamonds, which in turn exposes vast resources to fluctuations in prices for base and precious metals as well as rough diamonds. Corporate governance risk. Mr. Prelia and Mr. Tucker, two acting executive directors on the board of directors at Vast Resources, are shareholders in the AP Group that own a 20% interest in the Baita Plai project, representing a potential conflict of interest. Negotiations are ongoing regarding a conversion of the interest in the project into Vast shares in alignment of interests. Credit risk. The company is planning to direct $2 million of the latest $15 million, gross, convertible bond proceeds to close the $1 million SSGI loan and repay $1 million of the outstanding $4 million Mercuria loan. While Atlas loan facility is convertible into Vast shares at an adjustable conversion price, we see credit risk limited to the remaining $3 million owed under the Mercuria debt, plus accrued interest. Vast Resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Vast Resources Financials. SP Angel Company. The company divested its 50.1% interest in Ronquil Enterprises, through which it held 25.01% interest in Pickstone Peerless Gold Mine, leading to a deconsolidation of the latter that has been previously accounted for 100% in accounts. FY19 income statement and balance sheet are reported net of Zimbabwean gold assets. Company overview and ownership structure. Vast Resources listed on AIM in 2006 under the previously held name of African Consolidated Resources plc. One focused on precious and base metals projects in Zimbabwe. The company acquired stakes in Baita Plai and Manala polymetallic assets in Romania in 2015, expanding the geographical reach, and commissioned the 1.0 MOZ in reserves Pickstone Peerless Gold operation in Zimbabwe same year. The team divested the 25% effective interest in Pickstone Peerless in 2019, narrowing down the focus to projects in Romania and alluvial diamond concessions in Zimbabwe, and aiming to fast-track the existing portfolio of assets into production. Vast Resources main assets ownership structure. The remaining 20% is owned by AP Group, owned by Mr. Prelia, 50%, Mr. Kello, a former director of the company, 30%, Mr. Tucker, Business Director, 10%. Source, Company. 1 NAME changed in Mar/15. Romania. Baita Plai, 80%. Baita Plai, formerly Baita Plai, is a brownfield polymetallic deposit with a historic flotation processing plant located in the Apuseni Mountains, northwestern Romania. The area is known to host large precious, base metals, and uranium deposits. The operation has been on care and maintenance since mid-2013 and was acquired by the group in H1/15. After securing the mining permit in Oct/18, the polymetallic operation is in the development stage with first concentrate expected in H1/20 following successful completion of the development capital funding. The deposit is estimated to host 1.8 mt at 2.2% Cu, 3.5% Zn, 3.1% Pb, 1.4 grams To and 128 grams Tag2, 1-2 Lam assuming budgeted 13 ktpm production levels and 100% conversion, and with a small-scale flotation plant planned to be ramped up to production of 4 ktCu/eq per annum, including 2 ktCu with zinc, lead and precious metals byproducts. Location of vast portfolio assets in Romania. Source: Company. Baita Plai production profile. Production facilities underground operation is set to benefit from some 400 kt of ore in already developed mine workings located between levels 16 to 18, 260-350 m from surface, as well as refurbished underground and surface infrastructure including 2 operating shafts, one running from surface to level 13 and another one from level 13 to level 18. Shaft capacity is for 16 ktpm accommodating planned 13 ktpm plant throughput rates. After securing the asset, the company has invested in pumping capacities to keep mine workings dry while also looking after mine shafts, having replaced cages and installed new ropes. Mining equipment will need complete replacement with existing stopes to be developed using overhead shrinkage stoping with the blasted ore to be collected by mechanical front loaders, transported to the ore pass, collected at lower levels and loaded onto rail hoppers. 2 ball mills along classifiers owned by the group. 1 km tramway receiving end with the blasted ore to be fed into silos feeding the crushing circuit. Source: Company, SP Angel. Existing processing complex features standard crushing, milling, flotation and filtration circuit for production of base and precious metals rich concentrate. The site includes 3 ball mills, 7.5 ktpm capacity each, although only 2 of those are owned by the company, offering a potential 15 ktpm run rate, fully accommodating budgeted 13 ktpm production rate. 2 lines of flotation cells, thickener tanks, and filter presses are in place. Management suggests the amount of refurbishment works required to reach first production is minimal, focused on the pre-milling part of the circuit including installation of new crusher and conveyor belts among other things. $3.6 million budgeted development capex amounts to a low $23/t of milling rate, reflecting brownfield nature of the deposit with most of capital-intensive underground infrastructure as well as ball mills in the processing plant being in place. The plan is to launch production at a reduced 6 ktpm rate, H1/20, ramping it up to 13 ktpm over the course of 6 months, H2/20 in our model. Geology and mineralization. Baita Plai is characterized as a skarn deposit with faults-controlled high-grade copper, silver, zinc, lead, gold, tungsten, molybdenum mineralization. Faults are reported to be dipping at 55 to 70 degrees with encountered average mineralist widths of 6-8 m. Vast resources. Exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Exposed oxidized material in stopes at level 16. Sulfide mineralization in developed stopes level 16. Source: Company, SP Angel. Exploration works have been constrained as the group awaited the resolution of the mining permit application. The team is planning a drilling program in December 2019 to convert the available resource into JORC-compliant code. The mineralization remains open at depth with historic drilling returning mineralist intersections 90 m below the deepest level 18. See graph. which are believed to reflect a merger of two ore bodies and result in higher grade but narrower mineralization. Additionally, there are 7 skarn pipes identified at Baita, with the in-house mine plan currently including only 2 of those. Some 400 kt of polymetallic ore having been identified within the developed mine workings, which is enough to feed the plant for nearly 3 years. The team is in no rush to expand the resource but is in a good position to do so once funding is made available. Baita Plai cross-section. Baita Plai planned underground stopes. Source: Company. Metallurgy. The company commissioned SGS to prepare metallurgical test work on the Baita Plai polymetallic ore, looking at recoveries, potential to separate out zinc and lead as well as any deleterious elements in the final product. Results will help to determine optimal flotation plant parameters, target yields, recoveries, concentrate grades driving product marketability and smelter payabilities. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Metallurgical samples will be collected as part of the confirmation drilling program that commenced in December 19. Vast internal production model assumed low 78%, 69%, and 56% copper, zinc and lead recoveries and final concentrate for production of 28% Cu copper concentrate, 56% Zn zinc concentrate and 50% Pb lead concentrate. Baita Plai concentrate production assumptions. Processed grades. Resources and reserves. Baita Plai. Prices used for conversion to CUEQRSP Angel long-term forecasts. Non-JORC NAEN code C1 and C2 is equivalent to measured and indicated categories under JORC depending on the complexity of the ore body. Source: Company. JORC compliant resource reserve statement is to be prepared following the drilling program initiated in Q4/19 and released in H2/20. Infrastructure. The Baita Plai mining and processing complex has good road access allowing the delivery of mining equipment, spare parts and consumables as well as transportation of produced concentrates. The photo below features access to the site with the complex sharing space with an operating limestone facility. Limestone operation, run by Baita SA, next to the Baita Plai processing plant. Source: Company, SP Angel. The company has installed an independent power line with all trenching works and cabling completed with a view to source electricity from the national power grid in December 2019. Regularly inspected tailings dam facility has got capacity to accommodate future production while the team is currently in the process of replacing the 7-kilometer pipeline. The company invested $6.5 million to date, accounting for acquisition and legal fees as well as spending nearly half of that on keeping pumps running and keeping some staff since acquiring the asset in anticipation of development works. In the underground, historic mine. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Adits, drives and crosscuts are in place along with 3 access shafts and underground and surface rail tracks connecting the mine with the processing plant. Dual-purpose shaft at level 13. Winders at level 13 for the second shaft to levels 16 and 18. Source: Company, SP Angel. Development schedule. The company secured the mining permit in Oct/18 allowing African Consolidated Resources SRL, a 80% subsidiary of the company, to commence development works. Development works include a replacement of the existing pipeline to the tailings dam storage facility, underground infrastructure, ventilation fans and a shaft incline to new mining levels. Replacement of flotation cells, new crusher, mining equipment and refurbishment works on the remaining parts of the processing plant. Progress report as of Aug/19. Source: Company. Project economics. In arriving at project economics estimates we used Vast's in-house indicative production profile involving gradual ramp-up profile 3, guided development capital expenditures and adjusted operating costs. The company has identified a number of cost optimization options that is estimated to yield a 40% saving on the initial $81/t milled estimate. We used a mid-range between two estimates and applied $65/t unit operating cost. We applied our 3 source, http://www.vastplk.com/wp-content/uploads/2019/03/2019 production portfolio 29.01.19.pdf. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Own commodity price assumptions highlighted in the production profile in the table above to arrive at NPV estimates. Based on guided production rates, operating and capital costs as well as commodity price forecasts, the project NPV 10% is estimated at $77 million, post-tax, or $61 million for 80% vast share, equivalent to 0.32p in NAV per share contribution after adjusting for a 0.75p/NAV factor reflecting the status of the project. Baita Plai underground operation, 100%. Manila, 100%. The Manila Polymetallic Mine, MPM, is an open-pit copper-zinc operation located in the Suceava County, northern Romania, approximately 340 kilometers away from the capital city of Bucharest. The company acquired the asset in H2/15, taking over mining operations and the metallurgical complex producing copper and zinc concentrates. The mining license is for 0.3 square kilometers secured in the present expanded form in Feb/18 with the expiry date of 2021. The license can then be extended by 5 years every 5 years. Additionally, the company holds a 1.4 square kilometers license covering the adjacent to the pit area as well as the Karli Baba extension. Manila run at 3 ktpa in 18% Cu concentrate and 0.5 nitpa in 35% Zn concentrate with the flotation plant treating C. 10 ktpm of ore, 50% below the installed capacity reflecting a bottleneck in mining operations. In terms of metal output volumes, Manila produced 0.5 kt and 0.2 kt in copper and zinc, respectively, generating $3M in annual revenues. The mine is currently remaining temporarily suspended after having been placed on care and maintenance in mid-18 on the back of high operating costs and continuously running at negative FCF. The team is considering to potentially develop an adjacent Karli Baba deposit and build a new processing plant, $4 million, 2x 15 ktpm, in the vicinity of the mining operations. Both the Manila open pit as well as Karli Baba extension are estimated to host 4.6 mt at 0.97% Cu, 0.68% Zn, and 0.32% Pb in the open cut resource domain with another 1.1 mt at 1.58% Cu, 0.88% Zn and 0.82% Pb in the underground mineral resource, JOR compliant. Manila open pit, processing plant, and tailings facility layout. Source, company. Production facilities. The open pit polymetallic mine involves standard drilling, blasting, loading, hauling and dumping operation with a capacity of C.100 ktpm of material, or with waste, using contractor mining. Ore mining rates have been running low at. Operations have also been showing higher than planned mining dilution with lack of grade control drilling carried at the site, 30 to 35%, around 2x planned levels. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Tonnages mined, increasing waste stripping and target processing rates at Manila highlight mining operations bottleneck, quarterly data. Mined grades v latest resource grades, MNI category, highlight dilution issues. Source, company, SP Angel. The processing plant represents a retrofitted former manganese treatment facility and includes a standard crushing, milling, flotation and filtration circuit for production of copper zinc concentrates. From 2016 to 2018, the company has been producing separate zinc concentrate, establishing a second revenue stream. This, importantly, minimized zinc content in copper concentrate that previously attracted penalties from smelters. The site features 2 ball mills, one 4 ktpm installed in 2013 and 8 ktpm installed in 1970s, with a combined capacity of 18-22 ktpm. With mining operations running at. The plant is located 32 kilometers away from the pit, with transportation between mining and processing operations accounting for C.25–30% of mining expenses. Tailings are filter pressed and trucked to a former manganese open pit that was re-permitted as a tailings storage facility, TSF, 14 kilometers away from the site. Remaining TSF capacity is around 0.5 MT, equivalent to more than a couple of years at full plant capacity. 240 ktpa. Manila plant ball mills. Flotation cells. Source, Company, SP Angel. Geology and mineralization. Manila is a volcanogenic massive sulfide, VMS, type deposit with mineralization comprised of higher grade, darker colored massive sulfides running at 0.5 to 5.0% Cu and Zn, and lower grade, lighter colored disseminated sulfides formed on the flanks of the massive sulfide and containing 0.2 to 0.6% Cu and Zn. The ore body thickness ranges from 20.4, 24.7, 27.8, 23.9, 19.7, 27.7, 40.5, 23.6, 15.3, 26.0, 24.0, 0, 5, 10, 15, 20, 25, 30, 35, 40, 0, 10, 20, 30, 40, 50, 60, 70, 80. March 16th, June 16th, September 1st, December 6th, March 16th, June 17th, September 17th, 1 December 7th, March 17th, June 18th, September 18th, 1/8. Steepens around faults to 70 to 80. The mineralization remains open along strike and dip. In fact, Karli Baba deposit, which is set to become the source for the new 30 ktpm processing plant, appears to be an extension of the Manila deposit separated by a fault. Manila sulfide ore disseminated, left, and massive, right, sulfides. Manila open pit with operations running mid-2018. Source, Company, SP Angel. Infrastructure. The operation benefits from power grid connection and good road access, being located 26 kilometers from the local city of Ayakabini. The company operates an on-site laboratory, significantly accelerating assays of the collected drilling samples as well as verifying grades and impurities of the produced concentrate. Availability of skilled labor and the location of the dry stacked tailings waste dump, found 14 kilometers away from the processing facility, is a limitation. Resources and reserves. The Feb/18 updated mineral resource announcement highlighted above also included estimated exploration target over the remainder of the exploration license based on existing surface drilling and historical records. VAST estimates there is an exploration potential to increase current mineral resource by 35 ktcu or 80% in open pit domain. Defined as within 125 m from surface, and add up to 307 ktcu in the underground domain. Assuming top end of the range tonnage and grade. Karli Baba Extension Project. The company is planning to launch development of the new processing plant with a 30 ktpm processing capacity, 215 ktpm mills, next to the future Karli Baba open pit operation. They $4 million project is planned to replace the existing operation, allowing operating costs to be cut significantly by locating the plant next to the open pit. The company does not break out the Karli Baba resource from the total of 5.7 MT and does not run mineral reserves on the asset. Although, looking at the outline of indicated/inferred mineral resources, see below, Karli Baba accounts for major share of that, with management draft estimates pointing to a 14-year mine life supplying 0.80% Cu material to the new 360 KTPA plant. The company does not expect significant amounts of pre-stripping required. 1.5 m overburden, however, the long waste stripping ratio is expected to average relatively high 8.5x, which is still less than 1.6x times recorded over the last 12 months at the Manila deposit. In fairness, we highlight the elevated waste stripping ratio was also a function of limited mining equipment availability. The company is considering expanding the mining equipment to match expanded processing capacity that would help improve the availability of the machinery. Flexibility of operations, as well as allow to minimize initial capital outlay if leased from equipment providers. Karli Baba extension location relative to the Manila open pit. The outline of indicated and inferred mineral resource categories over the exploration permit. Source: Company. We expect the company to resume project design work, land acquisition, and concession agreement discussions once the two priority projects, namely Baita Plai and Chiadzwa Community Diamond Concession projects, start generating FCF that may potentially be leveraged off with bank funding for development capital. We have put together a provisional in nature and very preliminary DCF model using assumed throughput rates, grades, recoveries, and operating costs with adjustments to guided capex and life of mine estimates. We have adjusted development capex up to $8.5 million, applying a low $23/t mill size capital intensity estimate to 360 KTPA projected mill throughput rate versus C. $11/t guided by the company. This also amounts to half of the average $55/t capital intensities reported by other open-pit copper development projects, see below. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Capital intensities for open-pit development stage copper projects, $/t milling rate PA, with respective CUEQ annual production rates. Source: Company. Furthermore, we feel project economics would benefit from a shorter mine life that would, in turn, potentially reduce the average waste stripping ratio, which is currently assumed at high 8x for 1.0% CUEQ ROM, 0.8% CU and 0.6% ZN. Post-tax FCF drops to $1 MPA at 1:1x waste to ore, WO ratio. We summarize our main assumptions and respective DCF model results below. Karli Baba open pit operation, 100%. Karli Baba NAV is estimated at $16 million, equivalent to 0.03p per share contribution after adjusting for a 0.25 XP/NAV multiple reflecting the status of the project. The project would benefit from a detailed engineering study, metallurgical work and a mineral reserve estimate, allowing to narrow down project economics and funding options, which in turn would help to fine-tune potential NAV contribution of the Karli Baba extension project to the group. Additionally, more drilling across the exploration target area may help expand the existing JORC mineral resource and convert additional tonnages into the mine plan. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Exploration assets in Romania expanding the regional presence and building the pipeline of polymetallic development projects. Blueberry Project, 29.4%. Vast secured an indirect 29.41% interest in the Blueberry Project in AUG/18, gaining exposure to a 7.3 square kilometers brownfield area in the highly prospective for polymetallic mineralization Golden Quadrilateral region in the northwestern Romania. The region hosts such projects as Rosia Montana, 10 MOZ gold and 48 MOZ silver in reserves, Rovana Valley, 10 MOZ geo in measured and indicated resources, Certedge, 2. 5 MOZ gold and 16 MOZ silver in refractory mineralization reserves, as well as Rosia Poieni, nearly a billion tons of copper porphyry accounting for 60% of the nation's copper reserves and running at c. 5 KTPA in copper production per annum. Historic work completed on the project and more recent drilling returned encouraging results pointing to a potential to prove up a precious and base metals bearing mineral deposit. The area of the Blueberry project license, highlighted in green. Source, Company. The license surrounds the old Baita Aries mine that has historically produced gold from 6 breccia pipes accounting for 20% of total 55 MOZ of gold production in the Golden Quadrilateral region. Blueberry in turn is hosting a number of such breccia pipes that have been the subject to exploration works in the past including soil sampling, 159 assays, rock sampling, 98 assays, and surface drilling, 25 holes. Polymetallic mineralization occurs in sulfide-bearing veins developed adjacent to the breccia pipes in the areas of intense fracturing with veins dimensions of around 100-400 m along strike, 50-150 m in depth and 1 m in width. The mineralization is dominated by zinc and lead with copper being subordinate. Gold mineralization appears more prevalent in the breccia and occurs as free gold or inclusions within sulfides. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Recently, VAST completed a soil sampling program identifying 8 target areas for further surface drilling program. In particular, a new previously unknown anomaly has been identified that strikes 1,700 m east-west and returned an average value of 4.6 grams TO in samples. Of 8, 4 areas have been drill tested with 2 showing elevated gold and silver values over 10.0 m intersections. Mineralization has been intersected at or near surface within targeted breccia zones with high-grade mineralist zones intersected at depth within zones of veining and faulting. Selected assay results from the 6,800 core drilling program received over the 2018-19 period include 21.7 m at 3.14 grams TO from 25 m, AVBB009A. 6.2 m at 1.99 grams TO from 48 m, AVBB010. 16.0 m at 2.95 grams TO from 190 m, AVBB011. 39.0 m at 2.42 grams TO from 108 m, including 13.7 m at 4.10 grams TO, AVBB013. 24.0 m at 2.64 grams T from 19 m, AVBB021. 0.5 m at 9.83 grams TO, 147.0 grams TAG, 18.90% PB and 32.50% PB from 41 m, AVBB024. The team is planning to use the data to complete a maiden JORC-compliant mineral resource estimate as well as a feasibility study, development plan, environmental and social impact assessment and rehabilitation study to apply for an exploitation license. So far, Blueberry has been funded on a project level with institutional and private investors putting $1 million into EMA Resources, a subsidiary of VAST and a holder of the license, minimizing dilution for the VAST shareholders. The plan is to de-risk the project sufficiently to list the EMA Resources as a separate entity with VAST remaining as one of shareholders. Third-party investors have invested $1.0 m in the project. Zagra Project Pisciorol Zimbrului and Magura Negra licenses, 90%. The Zagra project is located in the Zagra Telcaiu area in Bistrița-Năsăud County in northern Romania. The project comprises 2 adjacent areas including the 10 square kilometers Pisciorol Zimbrului and the 21 square kilometers Magura Negra, with the company having completed a 4,000 m drilling program in 2018. The plan is to identify further targets and prepare a drilling program as part of the exploration license application. Historic exploration points to a copper-gold porphyry mineralization at Magura Negra and vein-hosted copper-gold mineralization at Pisciorol Zimbabwe. At Magura Negra, state-owned exploration firm, IPEG Cluj, carried a prospecting program in the 1986-93 period identifying 5 polymetallic veins ranging from 0.3 to 5.0 m as well as an 800 m long zone of disseminated sulfide mineralization intersected in an underground adit. The prospect benefits from underground access to mineralist zones with drives developed between 972 m and 1,340 mm slow. Preliminary estimates, non-JORC, suggest an exploration target of up to 3.0 bn tons of up to 0.8% Cu and 0.5 grams TO. 2,000 m of drilling was completed at the site in 2018. At Pisciorol Zimbabwe, previous exploration work conducted by IPEG Cluj included geological mapping of the 4.0 square kilometers area, 1,200 m of underground development and diamond drilling, 862 m of surface drilling, 238 m of pitting and 3,483 cubic meters of pitting. The work identified 6 veins with associated copper and gold mineralization along a 820 m long drive at the 835 mm slow level and 2 gold/silver/antimony bearing veins at the 950 m slow level. 2,000 m of drilling was completed at the site in 2018. The partner earned 10% into the project by spending $0.7 million. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Zimbabwe. Chiadzwa Community Diamond Concession, ownership TBC. The company secured exclusive access to the Chiadzwa Community Diamond Concession in the Marange Diamond Fields in Aug/18 to carry the necessary due diligence assessing the exploration potential of the area with a view to establishing a JV with a local partner for development of commercial alluvial diamond operation and marketing of Marange rough diamonds. The team is in final talks with authorities regarding the ownership structure and exploitation license regarding the project. The Chiadzwa Community Diamond Concession covers 73 square kilometers area in the Chiadzwa region of the eastern Zimbabwe. The project is next to vast legacy Marange Diamond Fields claims and is believed to be an extension of the same geological system hosting potentially economically viable diamondiferous alluvials as well as conglomerate ore resources. Given the prospectivity of the region that supplied 60 MCTS over the last 2 decades. Marange Diamond Fields in the eastern Zimbabwe. Source, Kitco. As part of the due diligence, the company engaged an independent competent person's preliminary geological assessment of the property that, in turn, highlighted a number of targets for placer diamond mineralization. Contiguous licenses recorded grades in the range of 50-500 cpht and typically 100-200 cpht and average prices of $80/ct. Company projections suggest the operation may potentially run at 2.0 mcts per annum. 90/10 split between industrial and gem quality stones, generating $120 m in turnover using $58/ct average value with 10% of production and 95% of sales proceeds coming from gem quality rough diamonds. At guided $20/ct or $10/t cash costs, including royalty, the operation is forecast to generate $77 million in EBITDA, equivalent to 65% margin, once fully ramped up to 110 TPH/XRT feed, assuming 4.1 MTPA in mining rates at 5.0 XXRT yields and 85% plant availability. Assuming 10-year mine life that amounts to 39 MT of mined mineral material and production of 20 MCTS generating $329 min NPV 10% and 473% We have adjusted management numbers down given the early stage of the project and preliminary nature of company projections, leaving a potential for upside revisions once the project is further de-risked. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. We assumed 50% availability on the 110 TPH XRT plant, reducing annual production post-full ramp up to 1.2 MCTS per annum while keeping same split between industrial and gem quality stones, that in turn generates $70 million PA in turnover, translating into $45 million PA in EBITDA at $20/CT cash costs. This brings down estimated NPV 10% to $187 million and ER to 286%. The plan is to finalize terms with the government and launch drilling, pitting, bulk sampling and trial mining as part of the mineral resource reserve preparation process, along with environmental and economic studies paving the way for a fast-paced development of the mining operation. Additionally, the company is referring to targets with potential remnants of the basal Umkondo unit in the area, which runs at estimated grades of 100 to 3,000 CPHT elsewhere in the Marange Diamond Fields, but involves more expensive mining, drilling and blasting, and processing, crushing, methods as compared to free digging and screening sorting used for gravel-hosted diamonds. Further exploration and economic studies should evaluate the economic potential of conglomerate diamonds. Development plans. According to the company's indicative development schedule for Chiadzwa Community Diamond Concession, the team is planning a geological evaluation, mineral resource preparation, engineering and environmental assessment work, phase I 6 months. Followed by a launch of production and gradual ramp up to 110 TPH XRT plant, phase 2 6 months, with the potential to further expand production rates should the scale of Chiadzwa proves to be larger than anticipated. The staged development schedule allows for a gradual de-risking of the project, helping the team to fine-tune the production process, potentially generate cash for expansion and further exploration, as well as optimize development funding structure. Proposed production facilities. Commercial production is likely to involve open cast mining involving excavating of diamondiferous gravels, loading onto ADTs and transportation to the beneficiation circuit. The processing flow sheet is to involve mobile screens, scrubber and wash plant to beneficiate the feed to remove fines and oversize before directing the material to the X-ray transmission, XRT, plant that detects diamonds based on the properties of treated material to absorb X-ray radiation. Diamonds absorb less X-rays compared to gangue material. The final stage in the recovery process involves sorthouse and the use of glove boxes where hand sorting takes place under secure and controlled conditions, e.g. camera surveillance. Provisional Chiadzwa Community Diamond Concession Processing Flow Sheet. Source: Company. We assumed Phase 2 production plan as our base case scenario with in-situ grades of 50 CPHT upgraded to 250 CPHT to be fed into the XRT unit that running at 110 TPH at 85%, company guidance, and 50%, SPA assumption, to generate 2 MCTS and 1.2 MCTS per annum, respectively. This compares to 5-12 MCTS per annum produced by the country in total, with more recent production mostly derived from conglomerate sources that are lower in volume but higher in value per carat terms and run at 2-3 MCTS per annum during the 201,618 period. Chiadzwa Economics Comparison. Grades and values. As previously highlighted, the management indicative production plan is for mining rate of 4.1 MT, gravel, per annum at a grade of 50 CPHT, assuming 5.0:1 beneficiation through the circuit to the XRT, with an average assumed value of $58/CT, which is in turn broadly in line with average values reported for Marange diamonds that ranged between $50/CT and $70/CT over the last few years. Low values for mined rough stones reflect high share of industrial quality stones, which again reflects the quality of regional diamond production, as 84% of Marange diamonds are reported to be of industrial quality stones that are predominantly used as abrasives, with around 8% of the production being of gem quality and the balance of 8% referred to as near gem of lower rejections, with only a small part of the rough diamond to be polished and used in jewelry. Kimberley Process Certification Scheme, KPCS, data. Although, it may be argued that high-value stones have not been included in official statistics previously, thus, which in turn biased average numbers downwards. Zimbabwe annual rough diamonds output V value per carat, $/CT, Zimbabwe rough diamonds production breakdown, MCTS, 2010-14. Source, Kimberley Process, USGS, SP Angel. The 2.0 MCTS per annum production rate is assumed to be comprised of 90% of industrial quality low-value stones and 10% of gem quality rough diamonds, with the latter accounting for 95% of total sales. While non-gem quality stones are expected to provide a byproduct value, it is production rates and values for gem quality diamonds that would define economics of the project. Breakdown in production BN gem and industrial quality stones, CTS breakdown in sales revenues BN gem and industrial quality stones, $M. Source, Company, Kimberley Process, SP Angel. Below we compare assumed parameters off the gem quality stones at Chiadzwa versus other selected, past-present, alluvial operations. While $/CT values come in below levels recorded by other operations, Lolo diamonds are currently ranked as the second highest in $/CT terms after the hard rock operations at Letseng that report $2,100/CT. Assumed grades at Chiadzwa compare favorably to other projects. Vast grades and values V selected alluvial diamonds mines, present historic. Asterisk vast preliminary illustrative projections, non-JORC. Diluted grades used V 8.9 CPHT in situ undiluted used 2 tons M3 density assumption to convert CPH M3 to CPHT. Lukapa operates Lolo mine in Angola, Wouterspan, Remhoekt/Halsloot complex, RHC. Sakendrift and Nujarskraal, NJK, are historic assets of Rockwell Diamonds in South Africa. Source, Company data, SP Angel. Geology. Stylized depiction of different hosts in which diamonds occur within the Chiadzwa concessions. Source, ZCDC. The geology of the Chiadzwa Diamond Fields area is comprised of the basement granites overlain by the younger Umkondo Formation sediments, that have undergone various degrees of deformation and metamorphism, according to the ZCDC. Regarding the diamond deposition, there must have been a period of erosion of the kimberlites lamproites after they were emplaced and before the formation of the Umkondo sediments, with diamonds from the primary source eroded and deposited into the basal conglomerate of the Umkondo Formation. As a result of weathering and erosion, some of the diamonds within the conglomerate are believed to have been released into the surrounding environments and now found in scree, rubble, lag material just above the basement granite and alluvial sediments confined to stream channels. 4. Botswana Diamonds JV in Oct/18, VAST signed an MOU agreement with Botswana Diamonds, an AIM-listed company led by an experienced team of explorers, developers and operators of diamond placer deposits headed by James Campbell, ex-De Beers, to develop diamond resources within the Marange Diamond Fields through an SPV, revised to 2.5%/97.5% BOD/VAST in Nov/19. Botswana Diamonds agreed to provide consultancy services over a 5-year period. A minimum of 40 hours per month, in relation to exploration, mining, processing and marketing at Chiadzwa Community Diamond Concession. Status: the Chiadzwa Community Diamond Concession is an early-stage greenfield pre-resource project. The team is currently in discussion with the state-owned Zimbabwe Consolidated Diamond Company Ltd, ZCDC, regarding an ownership structure of the concession area involving Katanaga mining. A JV between VAST and the Chiadzwa community representing Chiadzwa Marange local community, and the ZCDC. Given the abolishment of the Indigenization Act for diamond producers, the structure that would have previously involved VAST holding a maximum interest of 49% in the project is now subject to negotiations and is likely to change. We assumed 60% interest in the project held by VAST. The mining permit is expected to be secured in due course. As previously discussed, NPV 10% estimate based on guided production rates adjusted for the plant utilization rate, 50% V planned 85%, operating and capital costs as well as commodity price forecasts. Comes at $187 million, post-tax, for 100% interest in the asset or $112 million for 60% assumed interest to be held by VAST. This is equivalent to 0.12p per share NAV contribution after adjusting for the assumed 60% interest and a 0.15x status of the project adjustment. Chiadzwa Concession alluvial diamonds, 100%. Throughput XRT. December 2019. Board and Senior Management. Board of Directors and Senior Management. Brian Moritz Non-Executive Chairman, Board Member. Brian Moritz is a chartered accountant and former senior partner of Grant Thornton UK LLP, London. He formed Grant Thornton's capital markets team which floated over 100 companies on AIM under his chairmanship. In December 2004, he retired from Grant Thornton UK LLP to concentrate on bringing new companies to the market. He specializes in natural resources companies, primarily in Africa, and was formerly chairman of Metal Bulletin plc, African Platinum plc and Chromex Mining plc as well as currently being chairman of several junior mining companies. Andrew Prelia CEO, Board Member. Andrew Prelia joined VAST in 2013 leading the development of the company's Romanian portfolio. Andrew was involved in bulk iron ore and steel trading in Romania in the early 1990s before working in the property and earth-moving sector in Australia. After returning to Romania in 2003 he focused on the development of properties for the Romanian Ministry of Defence and latterly, private sector developments. Gaining extensive investor and public relations experience as well as advising the Romanian government on wide-ranging high-level topics including social housing and economic policy. He has built a strong network of contacts across the mining and metals industries in Europe and Southern Africa, in addition to policy makers and governmental authorities. Craig Harvey COO, Board Member. Craig Harvey joined VAST as a consultant in 2013 and moved into the COO role in Mar/17 overseeing projects in both Zimbabwe and Romania. Craig began his career with Goldfields of SA in 1988 as a bursary student in economic geology where he worked on various gold, platinum, coal, and exploration projects. At Harmony Gold he managed the mineral resources on various operations and was involved in due diligence on acquisitions. He worked for Simmer and Jack managing and auditing the mineral resource process across all gold and uranium operations while also spent 3 years in a principal consultant role for Ravensgate based in Perth, Australia. Conducting numerous resource estimations, valuations, and technical reports mainly in gold, uranium, copper and iron ore. Roy Tucker Business Director. Board Member. Roy Tucker is a chartered accountant with 43 years of high-level and broad-spectrum professional and business experience. He has been the founder of a London banking group, served on bank boards and had a position as a major shareholder of a substantial London commodity house. He is also the founder of Legend Golf and Safari Resort in South Africa as well as holds a portfolio of real estate investments in Romania. Eric Dyack Non-Executive Director, Board Member. Eric Dyack is a chartered accountant with years of experience in the mining and industrial sector having previously served as CEO of Anglo-American Ferrous Metals divisions, as well as holding different positions in a number of major listed and unlisted company boards, mainly associated with Anglo-American. He currently acts as a member on the Bidvest Group and Aveng boards. Nick Hatch, Non-Executive Director, Board Member. Nick Hatch has 35 years of experience in mining investment banking, primarily as a mining analyst in the equity research. He was most recently Director of Mining Equity Research at Canaccord Genuity in London. After leaving investment banking in 2017, Nick has recently set up his own company, Nick Hatch Mining Advisory Ltd., to provide mining research, business development, and financing advice. He holds a degree in mining geology and is a chartered engineer. Paul Fletcher, CFO, Board Member. Paul Fletcher has 25 years of experience working in the commodity and financial services industries. Previously, Paul worked for Bunge, the U.S. agribusiness and food company, as Global CFO and Controller of Bunge Financial Services, a Bunge Group business unit providing financing and risk management solutions, and as Treasury and Trading Product Line Controller. Before Bunge, he was involved in various senior roles within Cargill's energy business and internal audit, PepsiCo Snacks, and KPMG. Mark Mabhudhu, Executive Director, Diamond Division. Mark Mabhudhu is a Zimbabwean national and has over 25 years of experience in the mining industry. Mark spent more than 22 years in the diamond mining sector both in Zimbabwe and internationally, including 11 years with Debswana, the joint venture company between De Beers and the government of Botswana. Recently, Mark worked as CEO of government-owned Zimbabwe Consolidated Diamond Company, PVT, Ltd. and, prior to that, CO and CEO of Marange Resources, PVT, Limited. Mark has a BSc, Hons, degree in Metallurgical Engineering, an MBA, an MPhil in Information and Knowledge Management, and is currently working on his doctoral studies. Andrew Hall, CCO. Andrew works closely with the board of directors and is responsible for vast strategic business initiatives, capital raising, joint venture opportunities and investor relations. He has a background in natural resources and finance-linked businesses. Before joining VAST, Andrew worked at a natural resources-focused merchant bank where he established and managed the alternative finance distribution business covering asset managers, private equity, investment banks, family offices and trading houses. Source: Company. Shareholders. The company had 10,253 M shares in issue as at end of November 2019. Management and board of directors own just over 1%. The remaining shareholder base is largely comprised of retail investors. Major shareholders, OC/19. Source: Company. The number of warrants and options currently outstanding is 529M, warrants, exercisable at 0.5p and maturing in Dis/19. This does not account for the potential dilution from Atlas conversion rights, discussed below, as well as Atlas and Mercuria warrants. The company secured authority from shareholders for the issuance of 2,315M warrants to Mercuria as part of the $4 million funding secured in Mars/18, exercisable only to the extent necessary to repay the loan. Additionally, VAST will issue warrants for $3.75 million worth of shares at fixed price of 0.26p on each Atlas facility drawdown that expire on the third anniversary of each relevant issuance date, equivalent to 1,109M new shares at 0.26p price per share and 1.3 exchange rate. Balance sheet. The company had $0.6 million in cash as of reporting APR/19 date and raised £3.4 million, gross. $4.4M, in equity to advance the Flagship, Baita Plai and Chiadzwa projects since then. The company had $5.5 million in debt as of APR/19 with $4 million owed to Mercuria under the Tranche A drawn in 2018 and $1 million outstanding to Sub-Sahara Gold Investments, SSGI, who between two of them share a roughly 50/50th security over Manila Polymetallic. Mine. MPM. Post the drawdown on the $15 million facility and repayment of SSGI loan, Mercuria will hold a security over 100% in MPM through a 24-month standstill agreement. The team is currently finalizing the $15 million, gross, secured convertible bond with Atlas Capital Markets, a UK-based fund, offering development funding for Baita Plai and Chiadzwa as well as refinancing $1 million of Mercuria and $1 million of SSGI debt. The company secured non-conversion rights for the facility, allowing to potentially replace Atlas notes with a cheaper source of funding. See loan facility details below. Atlas secured convertible note amount $15 million, gross, and $13.5 million, net, in 4 tranches, $7.1 million, $4.5 million, $2.1 million, and $1.4 million. Drawdown. Tranches to be drawn according to cash flow needs and specific conditions. Term. 2 years from the date of each issuance. Conversions rights. Tranche 1 is subject to a 6-month non-conversion period, the tranche, plus interest, together with a premium if the share price is in excess of 0.24p at the time of repayment, may be closed in cash. Tranches 2, 3, and 4, Zimbabwe bonds, may be subject to a 12-month non-conversion period from the second issuance date, at the election of Atlas, but the PAR amount would double and to be repaid at the end of the 1-2M period. The company can elect to cash settle the conversion notice. Conversion price is the lower of 0.24p or 90% to 0 DVWAP. Interest rate 5% PA warrants. Right to acquire $3.75 million worth of shares at an exercise price of 0.26p issued pro rata to each drawdown, expire in 3 years of each respective issue date. Security. Security over Baita Plai and shares in the company's subsidiary holding the Diamond Concession. Use of funds. Development funding for Baita Plai and Chiadzwa Diamond Concession. Appendix I. Country profiles. Romania capital. Bucharest, 1.9 m. Population. Population 19.4 m. Official language Romanian political system. The system is a bicameral parliamentary republic involving the Chamber of Deputies, the lower house with 329 members, and the Senate, the upper house with 136 members, with both chambers directly elected for 4-year terms. Next parliamentary elections are scheduled for late 2020 or early 2021, with the National Liberty Party, PNL, currently leading polls, coming ahead of the Social Democratic Party, PSD, that secured most of votes in 2016. Elections and formed a coalition government with alliance of Liberals and Democrats. ALD. The Parliament approves the Prime Minister candidacy designated by the President. Viorica Dansla, a leader of the PSD, acts as PM since Jan/18. Next presidential elections are scheduled for 10 Nov/19, first round, and 24 Nov/19, second round, with the president eligible to serve up to 2 5-year terms. Klaus Iohannis, a former leader of the PNL and current president, announced his candidacy for coming elections, aiming for a second term. Economy. A former part of the Eastern Bloc of the Warsaw Pact, Romania came out of the communist regime more than 29 years ago and joined the EU in 2007. The nation is ranked number 5 among other 7 former USSR satellite states, 5 on GDP per capita basis, with $24K coming in below the EU's $38,000 but above $19,000 for the CIS region. Among other EU28 countries, Romania remains relatively poor, ranking number 26, with only Croatia and Bulgaria placed below. In absolute terms, the economy is the third largest, $240 BNV, $586 BN for Poland, the largest, and $15 BN for Albania, the smallest. Among the selected group of 7 countries. On growth, Romania was the fastest growing economy since the turn of the century, averaging 4.9% PA on GDP per capita basis among 7 countries, with the pace of growth normalizing from 5.3% in the 2000 to 10 period to 4.3% in 2010s. GDP growth hit a nearly decade-high 7% in 2017, led by private consumption on the back of indirect tax cuts and wage hikes both in the public and the private sectors. Growth came down in 2018, 4.1%, as the central bank hiked rates by 75 BP to 2.5% through the year to bring down the inflation that averaged 4.6%. 110 BP above the upper limit of the target 1.5 to 3.5% target range, with the IMF forecasting the economy to expand at around 3% from 2019 onwards. Government debt-wise, Romania has relatively low leverage, ranking in the middle of the pack with 28% in net debt to GDP compared to Hungary with 66% and Poland 45%, 2018. Although, the debt has been creeping up on the back of continuously running budget deficits, with the latest reading coming in very close to the EU 3% limit in 2018, -2.9%. In fact, the IMF forecasts the budget deficit to run at around 4% from 2019 onwards, highlighting the need for fiscal consolidation amid slowing growth. Trade-wise, the nation runs a high current account deficit, -4.6% in 2018, predominantly trading with EU members. Major exports include electrical machinery and equipment, 18%, vehicles, 17%, machinery including computers, 11%. Metals and mining sector is small, with iron and steel imports accounting for 2.9%. The S&P confirmed the BBB credit rating in March/19. Currency regime: Romanian leu, RON, is the national currency that follows the managed free-floating exchange rate regime to reduce FX volatility. No capital controls are in place. The RON has been oscillating in the 3.8 to 4.3 range against the US dollar over the last 4 years and depreciated 11% since the start of 2018, from 3.75 to 4.21, reflecting a general strength in the US currency as well as higher current account and budget deficits. Corruption. Romania is ranked number 61 of 180 countries according to the Transparency International Corruption Perception Index, next to Malaysia and Cuba. Among Western Europe subgroup, Romania ranks number 28 of 31 countries, 2018. Investment attractiveness. The Fraser Institute does not break out Romania in the Investment Attractiveness Index, with aggregate European region coming in number 3, behind the US, number 1, and Canada, number 2, while ahead of Australia, number 4, and Africa, number 6. Rankings within the subgroup vary significantly, with 5 countries, of 11 included in the regional index. Coming in the upper one-third of all 83 countries, another 4 in the middle one-third and 2 countries in the lower third, i.e. weaker rating Turkey and Greenland. 5 countries included in the sample, from richest to poorest: Czech Republic, Slovakia, Poland, Hungary, Romania, Bulgaria, and Albania. IMF. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Infrastructure. Infrastructure-wise, the country scores 55/140 based on the 2018 World Economic Forum Global Competitiveness Index, with only Bulgaria, 58/140, and Albania, 100/140, of 7 former Eastern Bloc countries ranking lower. Density of road network ranks 66/140, while the quality of roads scores 113/140, reflecting poor maintenance and underinvestment. Rail density is quite good at 18/140, although the quality of the rail network is somewhat below average, 75/140. The nation's power generation mix is one of the most balanced in the EU, with coal, hydropower, natural gas, nuclear energy, and wind power capacities installed, and electrification runs high, however, with the exception of wind and solar. Almost all units are fairly old, and most generation units outside renewables are government-owned that have not been spending on maintenance enough. Official installed capacity is around 22 GW, while utilization is low, with 7 GW used in 2017. 44% thermal, 23% hydro, 18% nuclear, 15% renewables. Mining industry latest data from the USGS, 2014, showed the mining sector represented an insignificant share of the economy, with only 60,000 people employed in the sector, of which a third was involved in the extraction of crude oil and natural gas. Another 30% in mining coal and lignite, supplying coal to thermal power plants, 3,000 involved in mining metal ores, and 9,000 in other mining and quarrying. The Metallifery Mountains in the Carpathian range of northwestern Romania hosts a number of mineral deposits rich in precious and base metals. The nation's largest copper mine, Rosia Poieni in Alba County, hosting nearly 1 billion tons of ore and accounting for 60% of copper reserves in Romania, is state-owned and operates at C.5 NITPA in copper production. Tailings management is an issue, with historic settling pond located in the place of former Gimena village valley. Most well-known gold project in the country, Rosia Montana. Located in the Alba County and hosting 10 MOZ gold and 48 MOZ silver in reserves, has been stalled over continued opposition from environmental and community groups over concerns regarding the preservation of historical sites and potential environmental damage. TSX-listed Eurosun is working on a BFS for the Rovina Valley gold-copper project located in the Hunedoara County. Together with Alba Country, part of the Golden Quadrilateral, hosting 10 MOZ geo in measured and indicated resources. Eldorado Gold owns 80% in the Certej refractory gold-silver project located in the Hunedoara County and hosting 2.5 MOZ gold and 16 MOZ silver in mineral reserves. Tax and royalties: 16% corporate tax. 5% royalties are charged on base metals and gold concentrates. Mineral rights are acquired through prospecting, exploration, and exploitation permits or concessions granted by the National Agency for Mineral Resources, NAMR. Exploration license is valid for up 5 years and is renewable for a maximum of 3 years. Mining license is granted for initial term of 20 years and is renewable for successive 5-year periods. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. Zimbabwe capital Harare, 1.5 m population. Population 16.9 m. Official language: 16 official languages, with 3 main languages: English, Shona, and Ndeb. Political system: the legislative branch is represented by a bicameral parliament including the House of Assembly, 270 seats, and the Senate, 80 seats, with members of both chambers serving 5-year terms. Next elections for the Senate and the National Assembly are in 2023. ZANU-PF is a leading political party in Zimbabwe that has been the ruling force since independence in 1980, long led by ousted Robert Mugabe, with Emmerson Mnangagwa currently acting as the party's first secretary. ZANU-PF has absolute majority in the House, 179/270, and is the largest party in the Senate, 3480, with the main opposition party being Center-Left Movement for Democratic Change led by Nelson Chamisa. Following a military coup in Nov/17, Emmerson Mnangagwa replaced Robert Mugabe, ending his 30-year-long rule. Mnangagwa won 2018 presidential elections in a close contest with Movement for Democratic Change Alliance candidate Nelson Chamisa having secured 58% v 44.3% for contender in the first round. President is elected for a 5-year term, next elections scheduled for 2023, with no limit on number of terms allowed. Economy. Zimbabwe is one of the few countries in the sub-Saharan region, SSA, that is on track to be poorer by 2020 when compared to the start of the century, with GDP per capita down 21% over the 2000 to 2018 period, with other countries in the same underperforming group being Central African Republic, -32%, Gabon, -9%, and Liberia, 5%. Of 45 SSA countries, as per IMF, Zimbabwe GDP per capita amounted to around $2,500 or number 23 in the sample. GDP per capita growth averaged 1.8% PA in the 2000 to 2018 period, which heavily weighed down by weak performance in 2000s as the government enacted a land reform at the turn of the century that confiscated farmland from white minority in favor of black Zimbabweans, leading to a drop in agricultural output, reduced exports, lack of tax revenues, food shortages, as well as resulting in a backlash from Western nations that cut off financial aid and investment. Farm production collapsed, and by 2008 output was 2/3s below its peak levels in 2000. In light of continuous budget deficits, the government resorted to increasing money supply that in turn culminated in the 2005/09 hyperinflation. Inflation rates reached 79.6 percent MOM, and 89.7 sextillion, 1021%, YoE, in mid-2008, at which point authorities eventually suspended official reporting of inflation rates and in early 2009 replaced the Zimbabwean dollar with a basket of currencies dominated by the US dollar. That helped to bring inflation back down. Authorities introduced bond notes, a quasi-Zimbabwean currency, in Nov/16, followed by the RTGS in Feb/19, and eventually suspending all foreign currencies in June/19. T growth averaged 2.8% this decade, v 1.1% for the SSA region, bouncing off a low base on the back of stronger agriculture and mining production. In 5 years to 2015, gold production climbed plus 120% to 20 tons, nickel plus 160% to 16 kt, Ni in Con, platinum plus 43% to 13 tons, palladium plus 44% to 10 tons, and bituminous coal plus 81% to 4.3 mt. On the other hand, diamonds, minus 59%, chromite ores, minus 59%, and ferrochrome, minus 21%, posted declines. Tobacco production has also favored better as output climbed from C.110 kt in 2010 to C.250 kt in 2018. The economy is expected to dip 5.2% this year, reflecting Cyclone Idai-related disruptions in H1/19 and budget consolidation plans in a bid to earn a track record of fiscal discipline, seeking future funding from international donors. Zimbabwe is continuously running a capital account deficit, minus 4.0% in 2018, that in turn adds to the shortage of foreign currency in the country, puts further pressure on local currency, and complicates repayment of $8.8 billion in foreign loans, VC. $20 billion GDP. Export revenues are dominated by gold, 28% in 2018, tobacco, 21%, nickel ore, concentrates and other products, 22%, as well as iron ferroalloys, 6%, and chromium ores and concentrates, 2%. Heavy reliance on hard and soft commodities leaves the economy exposed to metal prices moves and weather. Currency regime. The real-time gross settlement, RTGS, is currently the sole national currency introduced in Feb/19, designed to gradually move back to the Zimbabwean dollar and replace other currencies in circulation. Upon introduction, the value was set at 2.5:1 to the US dollar, however, the RTGS market rate has been falling fast amid deficit of foreign currency and rapid inflation rates, and reached 8.9, as of end July, based on the official interbank rate published by the Reserve Bank of Zimbabwe, implying more than 70% of value erosion in just half a year. Vast resources * exposure to copper and rough diamonds in Romania and Zimbabwe. December 2019. In June/19 the government suspended other currencies including the US dollar and South African rand from circulation, leaving the RTGS dollar as the sole legal tender in Zimbabwe. The decision has been criticized by the population, with unions threatening strikes if the government does not overturn the policy. Meanwhile, the nation is rapidly approaching towards hyperinflation, defined as plus 50% MOM growth in CPI. With inflation hitting 98% YoE and 176% YoE in May and June this year, that may in turn see the government opting to resume the usage of foreign currencies in the country. Zimbabwe, that is desperate for foreign currency, has imposed limits on retention of US dollar sales proceeds for gold and platinum producers to 55%, with the remainder to be converted into local RTGS. RTGS balances may be converted to US dollar for overseas payments,